Welcome to the Rose Show podcast. Thank you everyone for joining us today. Today I'm here with Larry Tentarelli, also known as Blue Chip Larry. Larry is a highly respected and experienced trader. Twitter accounts for investors to follow, and the most helpful trader on Twitter. So honored to have you here again, Larry. I think this is our third time meeting. How are you doing today?
It is. I'm doing great. Thank you, Rosanna. How are you?
Great, thank you. Everything's, we're getting ready. The market's closed tomorrow. I think it's a great time for us to talk about the whole market trend and what's been going on since our last meeting. So I think, are you ready to get started?
I'm ready. I'm happy to say that I knew you before your podcast made it really big.
Oh, you're so sweet. And I knew you for quite some time before yours is going to blow up as well, because your market analysis and trend analysis is one of the best. And I enjoy reading your reports, and you are calm amidst all this market volatility and everything that's gone on in the past few years. So we appreciate your valuable insight today.
Thank you.
You're welcome. The market trend is our friend. And Larry, as I said before, you're an excellent trend trader. So let's get started with the trend. I think it's a sideways market. I think if we could start with a bird's eye view, looking from last year into this year, what are your thoughts and what you're seeing with the overall market trend?
So great question. The first thing I'm seeing leadership in triple Q, the NASDAQ 100, and the larger cap quality tech stocks. So if we take a look at the triple Q chart, Apple, Microsoft, NVIDIA, I think just made a new 52-week high. But what we're seeing with these charts is they're over 4 moving averages. Their 40-week moving average has turned higher. They've got a series of higher highs and higher lows. So my focus right now in stocks is the NASDAQ 100 triple Q, the mega cap leaders. S&P, I'm not as S&P, I'm just neutral on. It's trending slightly higher. I think the cyclicals are going to be a drag on the S&P, the banks, the industrial stocks. I think that there's definitely signs that the economy is slowing. I think bonds are going to perform well. I think gold will perform well. And then I think it's going to be a very stock-specific market.
Wow, great. That was a great overview of that. So let's go a little deeper now. And let's speak. First, I have a general question. I know everyone loves to label things. I guess it's a way of simplifying, complex situations. So in your opinion, would you consider this a bear market still, or do you think it could be a bull market?
That's a really good question. Obviously, it's talked a lot about on social media. I would not say that we're in a bear market. I don't know that I could say that we're in a full-blown bull market for the S&P 500. I do think that the mega cap tech stocks are in a bull market. Apple, NVIDIA, I mean, we've got these stocks that are up 20, 30, 40% year to date. With NVIDIA at 52-week highs, it's really hard to say that that stock is in a bear market when the stock is making 52-week highs. As far as the S&P, though, if the S&P, we're right now 4,100 on the TV screen for the S&P. If the S&P was 4,100 6 months from now, I don't know that it would surprise me, because I think that the economy is going to slow, and while tech I think could do better, I think there's a lot of sectors that could underperform, and you could just get this range on the S&P, maybe from 3,900 to 4,200, 3,800 to 4,100. So in the index, you might get a range, but I think in certain stocks and certain sectors, I think that you could see nice outperformance.
Absolutely. Yeah, I was thinking the same as well. Sideways market, we're in that SPX range, or about, like you said, 3,800, 3,900 to about 41 to 4,200. And I think we're right around 40 something today, 40, 50, something like that, in that range.
Yeah.
So yeah, it's been a sideways market. A lot of comments from people saying, looks like we're back to where we were a few months ago. So it's been, volatility, sideways action. What are your thoughts on the NASDAQ? That was an underperformer last year. And last time we spoke, it was the Dow Jones. The DIA was outperforming and had the best, record at the time. And now it seems the NASDAQ has been showing more strength.
It has, and these markets move very quickly. And I think part of the reason, so I started trading in 1998. So I was actively there at the very, very top in 2000. I was extremely long, and I learned a lot because I rode those stocks all the way down. And I traded through 07, 08, 09. So I've been through a lot. The challenge to this market is you have so much different data coming from different directions, and the market moves like that. So one day we might get a jobs number that says that jobs are strong and the market all goes in one direction. The Fed's going to hike and everything goes down. And then 2 days later, we could get another economic report like we've got in the past few days that says the economy is slowing. And then you see these big counter trend moves. So what happens is the market doesn't know if it wants to focus on inflation or a recession. And you can't have both at the same time. They just don't go hand in hand. So one day inflation is the headline and the market goes into all the inflation trades. The next day it's recession. Jerome Powell says one thing. And that's the difficulty with this market, is that trends or breakout moves that start, which might normally follow through, will often reverse on a dime. I mean, look at what happened with the cyclicals a month ago. Industrials were breaking out, steel stocks were breaking out, and then the regional banks unraveled, and that cyclical trade went straight down, healthcare straight up, consumer staples straight up, gold straight up, and it's just very sharp moves.
Absolutely, it definitely moves quickly.
Quick.
It's very interesting. We talk about all this volatility. However, the VIX, the volatility index, is quite low. Do you think that's a meaningful measure of uncertainty and volatility at this point?
It's a good question. I don't think that the VIX has changed. So often I'll see these posts online and it'll say, the VIX has changed. I don't think over time that many things change. I do think recently there was a VIX spike to 30. I think when the banks unraveled a few weeks ago, the VIX spiked up to 30. So I do still think that if you get a big volatility event, that we'll see the VIX spike. But right now, what the VIX is telling me is that the markets aren't as concerned with volatility as many people think that they should be. And I think that the drop in 10-year bond yields from 409 to 330 has taken a lot of pressure off the stock market.
Agree. Great analysis and great points. Yeah, we'll have to talk about those yields that have come down, which signals that the market also is believing that the Fed is done with its rate hiking cycle and is looking to pause soon. And I think the swaps market is saying cuts this year as well.
Right.
So it's a lot of lot has changed just in the past month or two, and it's the banking crisis that has really changed sentiment regarding the Fed continuing its restrictive monetary policy, which in my opinion, I think they should, because the reason why, the banking crisis occurred, which is it's a symptom of all that free money, negative rates that we had.
Sure.
But yeah, that's a whole other discussion. But let's talk about these sectors. And I love that you mentioned the cyclicals are underperforming. I agree completely. I've noticed that myself. The semiconductors are usually known as a cyclical sector. And there's been a lot of talk and research lately saying that maybe they're breaking away from those patterns and they're becoming more, well, they are so important for everything we do nowadays. And maybe they become more inelastic. And do you think that the semiconductors are now becoming more mainstream and could remain in this bull market?
I don't think that they've changed their character. I think that semiconductors are still cyclical. Well, we went through this in 2000. We heard that tech stocks were immune to an economic slowdown. They'd go on forever. And then the market changed. So I could not tell you why semis are near 52-week highs and industrial stocks for the most part are rolling over. Now, home construction is near 52-week highs also. And I think that's because of the lower bond yields. I still think that semis are cyclical. And I really couldn't tell you, other than just pure money flow with money going into tech, I couldn't tell you why the disconnect between semis and steel stocks or the recent breakdown in energy stocks.
Got it. Thank
As
you.
long as they keep going up, I'm going to stay long.
Absolutely.
But if they break down, if they start to roll over, I won't chase them down.
Nope. And you'll be out for sure.
Yeah.
As will I. Yeah, I love that. They didn't convince you just yet that they changed their spots.
Not yet. They still have the same spots.
Exactly. They're still cyclical.
Yep.
You have a great report that you put out, and you were mentioning something that I was noticing as well. There's been a rotation. People are definitely going into the value stocks. Fundamentals do matter, and I've been tweeting and writing about that for a while. The staples, healthcare, commodities being real assets, cybersecurity. Powell, Alto, I've loved, and their earnings are fantastic too.
Very good.
Back. And I like the semis we talked about. Utilities, you're noticing a rotation into that as well? Tell us what you're seeing with all those sectors.
So it really started in March, the beginning of March. If you dial up the charts on, let's say, Eli Lilly, these healthcare stocks, utility stocks, and I think it really coincides with the breakdown in the regional banks, because when the regional banks broke down, bond yields broke down. Utilities perform well when bond yields come down because they're a slowdown trade. Healthcare had been underperforming year to date, but I think there's a rotation into safer sectors with fund managers, because keep in mind, you and I, if we want to go to 100% cash, we don't have to answer to anyone. Or if we want to go 80%, 50%, whatever it is. But a lot of these fund managers have an investment mandate that they have to stay 90% invested, 95% invested. So oftentimes what they'll do in times of market stress is they'll park money in stocks that might go down less than the next stock. So utilities are very low volatility. Real estate's gotten killed. XLRE's been very bad. But healthcare, so if you're a fund manager, if you and I are managing a fund and our mandate says our shareholders expect us to stay 95% invested, we can buy some ARC stock that might go up 10% or down 10% tomorrow, or we can park money in Merck or Con Edison that if the market, unravels, those stocks are going to go down less. So I think that's why you see that safety trade rotation right now.
Excellent points. I love that you bring up the institutions because they are the big whales. They're the big fish. We're the little fish. So they're the ones that move the market. So that's very important. And that point that they need to be invested. We don't. We can go to cash if we want.
Right.
But they are a different case. And, it's always about the risk adjusted returns. And that's exactly what you just said. Why would they take the higher risk, play like the ARKK,
right,
and versus like maybe a Boston Scientific or Merck or all these other stocks that you mentioned. And that's why we could be seeing this, move to these value, lower volatility stocks. So excellent points. And, there's always a bull market somewhere. I don't know who said that, but it's so true. And that's exactly what we're talking about. These sectors have shown, bull market, like qualities, and they, of course, can change in an instant.
Right.
So we have to watch them closely, but there's definitely been some nice runs in these sectors. So let's talk about commodities and silver. What are your thoughts with those? I know both of us initiated new positions. I'm back again into those, into that, but what are your thoughts on all that?
I think that gold has the potential to have a very big move. I think, and keep in mind, my views are based on what we know right now. On Monday, something could happen with macro, interest rates, whatever. But based on what I see on the charts and what my experience has been.
This is the first week in April for everyone.
Yep, April the 6th. What I think we're going to see is I think the economy will slow down. The Fed has gone from 0% interest rates to 4.75 to 5% in 18 months, 12 months, something like that. There's a lag effect to that. It's like an investment. You plant a tree seed today, it's not a full grown tree tomorrow. There's a lag effect to that tightening, but the yield curve inverted, I think it was the most inverted that it's ever been, or the most inverted it's been in 20 years, I'm not sure. And while I don't obsess over the yield curve and GDP and things like that, historically, a steeply inverted yield curve does precede some type of a recession or an economic slowdown. Bond yields are rolling over. The 10-year is close to rolling over. The 30-year is very close to rolling over. TLT is one of my favorite positions here. U.S. Treasury bonds. I think that we get a slowdown. I'm not ready to say full-blown recession, end of the world, Armageddon, these things that we see on social media. But I think that a slowdown could be expected. I think we're seeing that in the charts and some of these healthcare charts. And keep in mind, stocks sold off, 20-30% between the S&P and triple Q. So that sharp decline that we had in 2022 often precedes the economic slowdown. So in that case, I do expect bond yields to come down quite a bit. And I think gold is going to break out over this 2100 level. And I think it could, if you look at the long-term chart of gold, it tends to just chop around for years. But then when it finally breaks out, it's fast. And when we dial up whenever we dial up the charts, I'll show you a longer term chart. So gold tends to bounce around for years, but then when it finally goes, it moves very fast. And I think we're very close. If gold clears 2100, then I think we're off to the races.
Very nice. Yeah, I agree with you completely. It does move very quickly.
Here's in a nutshell, here's the bull case for gold. And I don't try to get too caught up in these things, but
awesome.
If you have a concern that the economy is going to slow down, or if you have a concern that the Fed is going to over tighten and they're not going to land the ship exactly with this soft landing that people are talking about, or if you think that the banking concerns aren't done, if any of those things play out, it's bullish for gold. If the banking issues are fixed, if the Fed gets it right, lands the plane exactly right, and the economy doesn't slow down at all, then maybe gold just trades around.
Great points. I agree with you as well on all of those. I think that gold has a place in my portfolio, 5 to 10%. Not too much, but I think it's important. And also, my opinion is that we're very much in like stagflationary territory. I don't like to label, I'm not an economist, I'm not some global economist, but my opinion, looking at all the indicators, it is definitely in that camp. So gold makes sense, or some other type of inflation protected ETFs, and T-bills I do like. There's a great way of laddering them, and you can have it for liquidity, right? And you can do it weekly, so you can remain liquid and have them maturing every week. And you have the risk-free rate higher than the S&P 500 earnings yield and NASDAQ earnings yield. Overall view is that, the equities market is on the costly or expensive side. So, and you're getting money from these T-bills, which they haven't been this high since I think 2007. So
very high.
Yeah, it's a different regime that we're in. And, a lot of people are talking about the bull market in the bonds is over. So we'll have to see how it all pans out. It's all speculating at this point, but from where we are at this point right now, like we said, the yields have been coming down. The 10 years down significantly. The 2-year, we still have an inverted yield curve. It was significant. It was over 100 basis points before.
Great big number.
Right now, it's about 50 basis points.
Yeah.
Right.
Yeah.
And then the 3-month is a big disparity as well, also inverted. I think what it's telling us is that the market, they believe that the Fed is nearing the end of its rate hike cycle. What are your thoughts on the Fed, and what do you anticipate this year?
I think they have to be near the end of the cycle. I try to prepare, I don't want to say for worst case scenario, but I try to anticipate what could put pressure on my position. So the CPI, so it came in at 6% in February. Cleveland Fed is forecasting 5.22 for March. So Fed funds right now is 4.75 to 5%. Let's assume that they hike again in May. Now you're at 5 to 5.25. If we've got CPI at 5.22, then you're at that level where the Fed funds rate would be over the headline CPI. It would be over the core CPI. And then I think I don't want to say worst case scenario. I think they could have 2 more hikes. If I had to take one or the other. I think that they hike in May. I'm not sure what happens after that, but we're definitely near the end. Whether they have 1 hike or 2 hikes, we're definitely closer to the end of the hiking cycle than 14 months ago, or whenever they started from 0 and have just been straight up. So whether it's 0 hikes, which is what the bond market is pricing in right now, if it's 1 hike, which is what I think we'll get, or if it's 2 hikes, in either case, you're at the end of that hiking cycle.
Yeah, makes a lot of sense. I think July seems like the kind of time period where they'll pause. We'll have to see, but yeah, I also agree a pause is incoming soon, more likely than we thought just 2 months ago. I mean, 2 months ago, I remember back in February, they were talking about going all the way. They had nothing planned. They had pauses, I think, later in the year or something. Yeah, and then now they're talking about cuts as well. So we'll have to see.
Keep this in mind, and for all of our listeners all over the world, Jerome Powell is not your friend. So anyone, we used to have the Fed put, and Powell would come out and save Wall Street. And I've been saying, I mean, you and I follow each other on Twitter.
Yeah.
I've been saying this for the past year. He is gonna toe the line with that message of inflation higher for longer. He's not going to come out. So in December 2018, he came out December, maybe the 19th. They had hiked 7 or 8 times over 2.5 years. In the fourth quarter of 2018, the market completely unraveled, and I was max short, like 70% short triple Q. So it was amazing for me. But he finally came out and he said, we are done hiking. And right after he said that, I think the next week, the S&P put, and this is all on my Twitter page, but the next week, the S&P put in the major low for that cycle, and it was off to the races. I do not expect Powell anytime soon to say we're done hiking. Even if they are done hiking, they might come out and hike in May. But unless there's just a total unraveling in the financial system where, banks are dropping left and right, some type of calamity. But other than that, I don't expect for them to say, we're done, we're going to pause. I think that they might be done, but I expect them to toe the line of the message that we're going to stay data driven, because the way that he jawbones the market, they want to keep the stock market in check because they want to keep liquidity tight. And because tighter liquidity, lower inflation, lower stocks. So he wants to keep that stock market down to a degree that he can. So even when they're done, I don't expect Powell to come out with the white flag or, they'll say, okay, start your engines. It's just not going to happen unless there's like just a massive, default somewhere.
Got it. I love that. No white flag wagging.
There's nice.
Yeah, and no end of the world coming. No doom and gloom coming as well. Per Blue Chip Larry.
Well, I can't predict no doom and gloom. I can't predict that because
no end of the world. Not end of the world.
I don't think we're going to see the end of the world. As far as financial stress, if we wake up on a Sunday and there's another Silicon Valley bank, but it's a bigger scale, because Credit Suisse was what, a $20 billion stock. I mean, they're big in the world, but they weren't big in the market. So we don't know what we don't know, but having actively traded through 07 and 08, and I remember, listen, I sat in my office and I was reading this Bloomberg report in 08 about Lehman Brothers being like 40 times leveraged and having really, whatever the number was, it was 15 years ago. But I remember reading these things and saying, wow, this is really like bad news. Like I was taking physical cash out of the bank and sitting on physical cash because I could read what was happening with these banks. I don't see that right now. They might have portfolio losses, but keep in mind, they might have portfolio losses from their bond holdings or whatever it is that distorts their balance sheet. But as these bond yields come down, those bond portfolios are going back up in value. But I just don't see the same, if you watch the movie The Big Short, I don't see, from what I've seen, I don't see the same subprime adjustable rate mortgage, people having, interest only loan. And so I don't see it to the degree from all the research that I've read that we've had in 08. So I don't think that this is an 08 scenario, just from what I see, but I'm not,
absolutely.
I don't have a crystal ball.
Yeah, great points. I agree. It's not like 2008. That was a credit risk. We're now more in the liquidity, that unrealized losses from those, those sovereign bonds, mortgage-backed securities, T-bills. And, my concern is the commercial real estate industry office is down, there are a lot of
Yeah.
vacancies, and the auto lending. Ally Financial is
Yeah.
definitely at risk, and
Yeah.
First Republic is another one. They have a lot of illiquid. I think there's like a ratio. They are a small to medium size. I know they're medium, I think. But I saw a chart, which was great, that just talked about what they had on their books and how they're really at risk.
Oh, sure.
So, yeah, so there's those issues. So yeah, we could wake up one day and find out, a new bank is now collapsing or something, another. So we never know. But
Right.
yeah, it's a different situation in 2008. This is more of a liquidity risk. And so it's different. But yeah, I mean, also Danielle DiMartino Booth, who I had on the show recently, said that the liquidity risk could go into credit risk. And,
Sure.
so anything's possible, like you said. And, that's what I love about you, Blue Chip Larry. And I love that name I gave you a while ago.
You made that name.
I did. I love it. It's so catchy.
Yeah.
And your experience and knowledge in the market and your amazing pattern matching, and that's key. That comes with, expertise-based intuitive decision making is from deliberate practice and experience in certain areas like you've had since 1998. And
Yeah.
you've lived through and you've experienced and you've been trading through all these other bear market cycles. And
Yeah.
you know what you're looking at and your experience comes through. So excellent points. And then, the opaqueness, not everything we see is everything that's there.
Right.
There are a lot of things we don't know about. And that's why there's a lot of uncertainty, especially during these times. I always say the only certainty is uncertainty. And so anything's possible.
In my office, I have on the wall, I have a little sign and it says, "We don't know what we don't know."
Yeah, exactly.
And that's why we can't sit here. I can't say, listen, the bottom is in. This is not, we can't say because we don't know what happens tomorrow. We don't know, but, and that's why I focus on price trends, because what I assume is that while the market's not necessarily efficient, it does adapt very quickly to new news. And we saw that with the regional banks. But that's why I focus a lot less on opinions, like zero on opinions and predictions. And I just look at the chart. So I think, for example, that gold could break out here. But if it doesn't, and if it starts to roll over and it goes down, 1900, 1800, 1700, I'm not going to be chasing after it, buying it with both hands and saying, well, even though it's going down, I think it should go up because of X, Y, Z. To me, the chart is the truth.
Exactly.
The chart is the reality. You're very smart. I think I know what's going on, but guess what? The collective wisdom of the market, no matter what I think, there's someone on the other side that's been at it longer, that has more money, and they think just the opposite. So that's why I just look at the chart at any given time and I say, okay, the collective market is smarter than all of us. And while it can change quickly, if that trend is moving higher, who am I to say, well, the trend is higher, but it shouldn't be? If the trend is lower, who am I to say, well, I know it, I'm right, and everyone in the market is wrong. So that's why I don't spend too much time. I've got a base case view of what I think will happen, but a lot of what I think will happen is based on what the charts are telling me. So the charts are telling me that gold could break out, bonds could break out, and that would mean the economy is slowing. But if those charts turn, I'm not going to fight the chart.
Love that about you. And that's exactly what we're going to be focused on later on in the trading psychology part.
Perfect.
It's about being humble, and it's not about being right. It's not like I want to keep, I'm right. Gold's going to go to 3,000. I'll chase it all the way down to 0 if I have to, because I'm right. And it's like, no, we're here to make money.
Right.
And so accept that you were wrong and move on.
Right.
And keep your trading plan in place. If that trend moves against you, I'm out.
Sure.
And, and that's how it is. It's not about being right. And we need to avoid biases and heuristics as well. And we're going to get into all that. I'm so excited
Yeah.
to get to that. But before we get even into talking about your trading style and price and volume, which are my favorite indicators,
Right.
it's all about supply and demand, and I want to talk about the dollar.
Okay.
What are your thoughts on what you're seeing with DXY, the dollar index, and also, which is also important because the dollar doesn't exist in a bubble.
Right.
It's compared to other currencies like the euro, the yuan. What are your thoughts of what you're seeing with the dollar right now? I think it's hovering around 101.
For my time frame, the dollar is in a downtrend. So it peaked, I think, and I don't have the chart in front of me. I think it peaked in September.
Yes.
It's been working its way down since then. I think with a weaker economy, you might get a weaker dollar, but it's tough to say because I've read some research that said that in a recession, the dollar could actually hold up better for a lot of different reasons. So instead of me trying to connect all the dots, I just look at the chart. So for right now, the chart's in a downtrend. So I don't have a position in the dollar. I'm long gold, which somewhat trades against the dollar. If I had to have a position in the dollar right now, it would be short, but I don't have a position in it overall. As far as if the dollar weakens, the euro should strengthen. If there's a slowdown, we'll have to see how the Europe economy works out. But just as far as the actual dollar chart itself, it's in a downtrend for my time frame.
So next question regarding currencies. What are your thoughts on Bitcoin as an alternative currency? It has been holding surprisingly pretty well, 28, 29,000 last time I looked. And, it has an inelastic supply. And at the same time, do you think it can coexist as an alternative currency? It has been showing strength during this time period.
Yes. So I'm a believer in Bitcoin. I've got a very small, maybe 1.5% in Bitcoin that I just hold, and I've basically written the money off in my head. I think that Bitcoin, it's very speculative, but anything could be speculative. We just saw tech stocks go down 80%, right? Shopify dropped 80%. So anything can be speculative. I think that in the grand scheme, I think that 5 years from now, 10 years from now, 15 years from now, I think Bitcoin is higher than where it is right here. I think it's real. I don't follow it every day. I don't trade it. I just have some that I've put away and tried to forget about it. I don't do anything with Ethereum or any of these other coins. I don't know anything about any of that. But the concept itself of Bitcoin, I think it's just going to get bigger over time. But you're going to see 70, 80% drawdowns. But if we look at a chart over whatever, 10 years, every 70 to 80% drawdown, it's made a new high. And so I think that, for 1%, 2%, whatever somebody wants to say, okay, this is, I was going to go on vacation for a week, but I'll just put this money on Bitcoin and forget about it. I think Bitcoin is here to stay. And I think it'll be worth more in 5 years. I just have no idea in the short term what it'll do.
Excellent points. Have you been peeking at my portfolio? I also have Bitcoin. That's funny that we said that. I believe, in my opinion, for my portfolio, I like to have exposure to gold. And then, of course, if it turns against us, we're out. But also Bitcoin. And I've also have some that I've just holding on to it. And but I don't have Ethereum and the others. But Bitcoin to me is proving to be so far, of course, anything can change, to be a store of value in some ways, and also a potential alternative currency. So yeah, you have a small portion, like I said, gold 5 to 10%, maybe Bitcoin 5 to 10%. something like that or less. And I also believe that it should probably go higher and long term. We don't know the short term. There's a lot of volatility, a lot of risk with that. Who knows? It could come back and, new low, this year, or can go on to higher. We'll have to watch and see. But I also like to have a little in my portfolio.
If I held the original Bitcoin that I bought, I'd be talking to you from my boat right now, because someone
we'd all be on your boat.
listen, we'd all be on my boat. Someone told me about Bitcoin on Twitter, maybe 2013, 2014. I don't know if it was even around. It was a long time ago. And I looked on a chart recently of what the price was then and what it is now. And I had it, and I traded it, and I sold it. So I just decided I do think Bitcoin, though, I think it's going to be here for a long time. It'll just be volatile, but for me, just very small. And I really don't even look at the chart every day, because if I did, I'd probably be tempted to trade it. And I don't want to do that with it. So it's just, I wrote it off, and I think it'll be worth more.
Excellent point. I love that what you just said. See, there's so much wisdom in the little things you say. And you just said, I don't look at it because then I'll be tempted to trade it.
I will trade it.
See,
and I don't want to.
Yeah, see, you know yourself, and you know that's trading psychology. It's about knowing yourself, and that if you're going to do something that you don't want to do, you avoid, the precursor, which is watching it. And yeah, I agree. I don't really watch it as much.
Right.
There's a great point that someone made recently. They're like, there's an argument against Bitcoin that says there's no real value behind it. And then they're like, well, is there really a value behind the dollar? Like, we're not on the gold standard or anything, but what is the real value besides the government behind it? But so it's like, it's an interesting point if you look at it from a different perspective. And, I just believe that Bitcoin has, potential, like you said, to continue higher. And I think it could be an alternative currency. And especially in this time period that we're in, of like debasement of fiat, persistently elevated inflation. And I love that point you made earlier, which I always talk about, is, everyone's so focused on the rate hikes, but they're not talking about the money supply. And it's really we had the fastest increase in the money supply in decades. And too much money chasing too few of goods and services that really causes inflation. So they need to keep their hand, the Fed needs to keep their hands also on, the quantitative tightening and, reducing that money supply. So to help bring down that persistently elevated inflation. And we still have the rising core month over month, with the CPI recently. And, it is moving in a better direction. So I'll give it that. We'll have to watch and see. And like you said earlier, data dependence. That is also what I believe the Fed will be doing. So, and the J Powell is not your friend. I like that one. That's a good one.
He's not going to ring the bell. He did it in 2018. He's probably not going to do it right now.
I like that. Great. So, Larry, let's talk about your charts. Your trend analysis is fantastic. And tell us about your favorite indicators. I know price and volume, both you and I love that. And price is the ultimate evidence that we need. And so tell us about what you look at, if you could share with us, please.
Do you want me to bring a chart up?
That'd be great.
Okay, let's go
to you like, and just tell us how you analyze the trend.
Okay. So should I bring the chart up?
Yes, go for it.
Share screen. Let me just check. We will do share screen. And can you see my triple Q chart?
No, now I do. Yes.
Okay. So what I look at, and let me get this refreshed. I look at really two key things: price and moving averages. I do look at volume, but I don't overthink volume. And if the price is trending in a direction, I don't let the fact that the volume might be lower stop the price trend. But the key thing that I want to see, if we look at this triple Q chart, and I'm actually going to dial it out just a little bit longer, but I look at the trend of the price. So what I see in this price right now is I see, we'll call it a low in January, December, 259. I've got a higher low in March at 284. I've got a high at 313, and I've got a high at 321. So I've got a higher high, I've got a higher low, but the key thing is the moving averages tell me the trend of the price, because all the moving averages are just a smoothing mechanism of the average price over the past 20 days, 50 days, whatever. And when I see these moving averages, number one, turn up, and then number two, stack on top of each other. So the 20-day is over the 50-day, is over the 100-day, and they're over the 200-day, and the 200-day is all turned up. That's an uptrend. So it doesn't matter to me whatever anybody has to say about anything else, the economic cycle and all this. That chart's in an uptrend. So what I want to do is look for a position there, find the uptrend, and then set a reasonable stop. So just by looking at this chart, for a basic trend follower, as long as this chart stays over the 50-day moving average, which is 302, for an intermediate term time frame, we would call that an uptrend. For longer time frames, as long as it stays over the 200-day at 290, then it still has an uptrend that's in place, and that would also keep a higher low versus 284. But to me, higher highs, higher lows, moving averages rising and on top of each other, that's an uptrend, and that's a chart that I want to be in.
I love that. I love your charts are always so clean, and that's so important. I want to mention that, we have bandwidth constraint, and, we already bombarded with so much information. And you had said that earlier, how there's just so much data coming at us from all sides. And so we want to simplify and eliminate the noise. And that's such a nice, clean chart. And the higher highs and higher lows, that's classic uptrend to me as well. Nice. And those moving averages that you prefer, is it the 200, the 50-day, and 21 or 20-day?
I use the 20-day, 50-day, 100 and 200-day. But the 100-day, I have it on there as a bit of a smoothing filter, but most of what I do is 20, 50, and 200-day based.
Nice. And do you use an anchored VWAP?
I don't. I know that a lot of people do, and from what I hear, it works pretty well. So, but I just haven't used it. What happened is I spent so much time figuring out what to use that worked for me, and it took me years and years to get to what works for me, because keep in mind, what works for me is based on my personality and my time frame. So I have a slightly longer term time frame. I can endure volatility. I expect pullbacks, and I structure my positions that way. But there are some people, I've got friends and I know people, that if a position goes against them by 2%, they've got to get out of it right away. So my signals might not work for their mindset or for their mentality. So they might use, much shorter term signals. But I do acknowledge that there are many ways to skin the cat. And I think whether it's VWAP or VCP or, reversion, overbought, oversold, I think if someone spends enough time working on it and testing it and refining it to what their mindset is, I think that there's a lot of different systems that can work.
Absolutely. Perfectly said as well. like a professor. I love the way you explain things. And it, once again, it goes back to mindset and trading psychology. Do what works for you. It's about knowing yourself and what works for you. And that's what works best. And keeping it simple and, you know, and knowing that is key. So I have to ask you, when you said your time frame and you mentioned that, what exactly is your time frame? What time frame works best for you, Larry?
For me, when I get into a position, if the position starts to work, I could hold some part of that position for over 12 months. I could hold it for 2 years if the position starts to work. If the position doesn't work, I could be out of it in 3 days. So what I want to look for is if I get into a position, and generally what I do is with ETFs, I tend to be a little bit more active as far as a little bit more tactical, maybe take some gains on the way up, scale some gains. But when I get into a stock position, or let's say, for example, gold, I'm not buying it with the intention of getting a 2 to 3% gain and then selling it and then going to find something else. I'm trying to get into some trends that if they start to work, I want to continue to hold a position.
Nice. So
Now I might book some gains along the way.
of course.
I might trail, move my stops up.
Mhm.
But as long as it's just gradually trending higher, then I want to look to try to stay in that position.
Nice. Maximize your returns there. So your stops, let's talk about that. I know it depends on the stock and your entry point and everything, but what is a general rule for you with stop losses?
In this current market environment, my standard stop will usually be 8 to 10%. So what I'll do is take a look at the chart. I'll look at where is support, technical support, where is moving average support, and I'm going to try to get within a 10% range from, if this is my entry point and this is my stop level, I want my stop to be either underneath a moving average, underneath a recent price low, underneath recent support. And if it's a more volatile stock, then I might take a smaller position and maybe run a 12% stop. So because the way I look at it, for example, I just started a position in C Limited over in Singapore. So I had C in 2000. I had it in 2001. And I made a lot of money with it. And I was fortunate enough to sell it at the end of 2001 when it broke the 200-day. But I've got a new position in C. But what I know about C is that it's an extremely volatile stock. It trades over in Singapore. But when I look at this chart, so I was fortunate enough to have sold it at about 270 back in 2021. And I've been watching it forever, and it built a base, and now it's trying to break out. Here's what I know is I've got a small position in C, and I could get stopped out. But I also know that just from looking at this chart from 370 down to 40, and right now it's at 84, C just turned a profit for the first time in the history of the company. So think about this. They're in Southeast Asia, Singapore, and they're in online gaming, e-commerce, and electronic payments in a very high growth market. And they just turned a profit for the first time in the history of the company. So to me, if I'm going to risk, I think I've got a 12% stop here, which I'll move up over time. But for me, I've got a very small amount of risk. And I think that my upside, could it go up 50%? It could. It could go up 100%. Maybe I get stopped out and I give up 12%. But to me, I don't want to not take a position just because it's very volatile. So I'd rather take a smaller position, have a little bit wider stop. And then if the stock starts to work higher, which I think it will, then I can add to my position. I can raise my stops up. I can take the risk out of the position. But so Here I've got a 12% stop, but generally in this volatility, 8 to 10%. Let's say it's a year from now and the Fed is done hiking, and let's just assume that we're past this stuff, and I'm not a prediction, but maybe we will be. Then when the markets start to get down into maybe a better trend, my stops might go to 6 to 8%. So a lot of it is based on the position volatility overall. But I've got some high octane positions right now. I've got more cash, but the positions I do have, stocks like AMD, Meta, Palo Alto Networks, I've got some high volatility positions, but I have higher cash to offset the volatility.
Love those strategies. Thank you so much for sharing that with us. Such valuable insight there. Love that chart. And yeah, I agree with you. Seagate was one of the ones I traded as well and did very well with. It's a fast runner. It definitely moves quickly, and that risk reward looks enticing there. And the fact that they just turned a profit is huge.
And that's where this giant volume bar, it's a little bit harder to see.
I see that.
Yeah, they put in a giant volume bar. And here's the thing. There's a lot of fund managers that might have a mandate that says they can't invest in unprofitable companies.
Yes.
So now C turns a profit, and it could open up, an entire new universe of fund managers that can buy the stock. But to me, I think an investment in Southeast Asia, in online gaming, e-commerce, and electronic payments, to me, that's the sweet spot.
Oh, for
because
sure.
It's in Singapore, it's not as subject to what happens with the Chinese stocks and China regulations and things like that. So this is, I hope we do a podcast in a year and C is 150.
Oh, that'd be great. Well, definitely. I'm thinking, I have traded this one quite a few times. And so I'm looking at the chart, and it looks, thank you so much for bringing this back to my attention. And because I believe in diversification across, diverse group of asset classes, alternative investments, but also diversification, which helps reduce risk. And I'm a fan of diversification. Diversifying across emerging markets and global markets. So this is very smart, blue chip Larry. Going to Singapore, which, and this is a great company, Seagate. I love it. They're gaming. They're a great one. And being diversified outside the US, I think is very smart, especially during this time period. I'm also diversified outside the US, but this is definitely looking very nice with a nice risk reward scenario. It's always about the risk adjusted rewards. We ask ourselves, how much can I lose before how much can I make? It's about risk management, which is always number one. And just like you, I like to scale in and scale out, meaning that I build my position over time, and then I take profits along the way.
Right.
I've been saying the same thing as you, which I love. I love when we're saying the same thing. It always makes me feel great about things. You said that in this type of market with volatility, it can be easier to build positions because you're given these pullbacks along the way.
Right.
So that's always looking for the positive in these challenging environments, because the challenging environments do offer opportunities. We just have to look for them and seize them. So what chart are we looking at now?
So this is the longer term chart for gold.
Ooh.
For spot gold. And I'm actually going to dial it back even further. So this is the monthly chart for spot gold, but what you can see, and we'll go back even further, but what gold tends to do is it tends to have these huge breakouts, and then it does nothing, and then it has these huge breakouts. So if you look at spot gold, 1993, it was $400. In 2003, it was $373. So 10 years later, it was flat. But then when it broke out, we can see it broke out from 400 to 1,000, pulled back to 2,000. So it went maybe 500% 450 in a 9-year period. But now from 2011 to 2023, which is a 12-year period, it's basically done nothing. It's been the same price. So it traded down quite a bit. It traded up quite a bit. And for traders, there's been a lot of opportunity to trade this chart. But if someone just bought gold in 2011 and held it to today, they're up $100. But what happens is we can see gold went for 10 years, and then it had a big breakout. It went for 12 years. Now it's trying to break out here again. It really needs to get over 2,100. But I think if gold can clear 2,100, then I think it could open up another part of the chart. I think you could open up a whole new level, because it was in 1993, it was 400. Today, it's 2,000. So it's up, what, maybe 500% or so. But gold historically will do a lot of nothing and then have a big breakout. So, you know, as a trend follower, I stay up at night hoping to find charts that are going to break out into multi-year bull markets. And we don't know that this is the case. But once again, to me, I've got a 10% stop. And the upside could be, we don't know. And that's the thing about risk and reward. So I'm probably not going to buy any utility stocks anytime soon, even though they're working. Because if I look at, let's say, Con Edison, you know, the stock is the same price that it was a year ago, and it's probably higher over time. Let's look at 5 years. It's probably higher, 72 to 98. So it's up, what is that? Maybe 30% in 5 years. But to me, the potential reward doesn't greatly outweigh the risk in a utility stock, or maybe even in Coca-Cola stock, let's say. So if I'm going to take a position, I want to see at least the potential to maybe make, you know, 2, 3, 4 times what my risk is to take that, to get excited about that position. If not, I would rather just sit on cash and wait until some, you know, a good potential reward position comes up. So gold, I think, you know, I think that there's a lot of good cases for gold. We'll see if it can break out. I think that bond yields look like they're ready to roll over. I mean, we can see the chart starting to roll over now, but if we draw up the bigger chart, you know, it looks like the start of a rollover top in 10-year bond yields. And I think the only way that bond yields go back over 4% is, you know, inflation would have to really turn around sharply.
Now, I have a question for you. I love that you just said, first of all, your charts are awesome and your analysis is amazing. And I'm going to say this again. I've said this before. I've always told you this since I first met you. Your calmness amidst all this volatility is amazing. And that's so important about remaining calm. And I love that. And you have confidence, yet you are fully aware and you're willing to say you're wrong and be out. And I love that. So I want to go to, you just said inflation.
Yes.
Let's talk about OPEC. OPEC just recently cut their supply. And there's a lot of talk that they think energy prices will go up. USO, can we look at anything in that USO or energy or oil or anything? Do you think that that could re-accelerate inflation? And what are your thoughts on oil based on that recent news?
I think so. Oil sold off pretty sharply from 123 to 60. So basically, crude oil, WTI, got cut in half in less than a year. It recently hit a 30 daily RSI, which was oversold. So it's bounced right now. The first line in the sand for me would be $85 in WTI, which is above. It's had resistance 82, 83, 81 for about the past 5 to 6 months. And it has a declining 200-day moving average. So I don't have a positioning in crude oil, long or short. But in order for me to want to take a long position, I would need to see it close over $85. And I think if you have a view, so I think that there could be a slowdown. Now, keep in mind the fact that crude oil is down 50% off the top could have discounted a lot of that slowdown already. China is coming back online. But to me, as far as a trading position, it would need to close over $85 for me to want to have a long position, just based on what I look at.
Nice, very nice. I like how you use the charts to give you the signals of when to think of initiating a position. Very smart. Now, yeah, we talk about not predicting, but reacting. And that's exactly what you're doing here. You may keep an eye on it, but it has to hit that critical level to demonstrate strength and a trend in the upward direction. I like that. That's great. Thank you so much for sharing. So let's talk about risk management and your mindset. Risk management is number one. We've had a very difficult year recently. Some people said it's the most difficult they've had, and they've been trading for 35 years. It's just the choppiness, the back and forth action.
Right.
How do you maintain a risk management mindset?
The first thing I do is I hold a lot more cash. So what I found is the best hedge, and there's a lot of conversations about hedging and shorting and options and things like that. For me personally, the best hedge is more cash and less exposure, because you could hedge, you could buy put options and get it wrong, right? You could buy put options on the index and hold a bunch of stocks, and the index could go up and your stocks could go down and your puts expire worthless. You could short the index and not get your timing right, and you could be short the index, you could be long stocks, the index could go up, it could take out your short, and then your stocks could go down and you lose money in both directions. So what I found for me personally is more exposure and more positions leads to more mental volatility. So what I need in a high volatility market is I need less mental volatility. So instead of trying to get, fancy and load up on stocks and then load up on puts, I would rather just have a lot more cash, because I know my cash won't fluctuate. Bond yields might go up and down, stocks might go up and down, but cash is cash. I don't buy into the, inflation eats into your cash.
Yeah.
Cash is money in the bank, and it allows me to sleep at night. So in a higher volatility market, I think I've been over 50% cash since last February. When the war started, Russia, Ukraine, I went to 50% cash, and I've been over 50% cash. Sometimes I've been higher. But that's the first thing that I do. Then the second thing that I do is I just play small. I'm playing small in this market. I've got smaller positions because I know that I could be wrong. I know that no matter what my chart says, tomorrow, if the jobs number comes in really strong, guess what? Gold's going down, bonds are going down, and stocks might go down. No matter what my chart says it's an uptrend, but the employment report is huge. So because I'm aware of that volatility that I have no control over, I have smaller positions. I still have to participate. I can't be 100% in cash, because if you're 100% in cash, you get disconnected from what's happening in the market. So I still have to participate, but I just do it with smaller positions. I'm okay winning smaller right now and losing smaller right now, because this will turn at some point, whether the turn is already here or if it's 3 months or 6 months. And there will be a time, at least for me, to be pedal to the metal. But in the meantime, I just need to keep that volatility low, and I do that with cash.
Excellent points. Thank you so much for sharing that. I agree with you. I do the same. The whole hedging thing isn't really for me, like buying, sometimes I do different things with options trading, and that's different, but maintaining cash. And I recently did a podcast or a video on cash is king or queen. And I just talk about how, it's important to remain liquid to seize opportunities. And this whole thing about inflation, well, if I'm invested and I make myself get invested, then not only do I have inflation, but I also have potential losses working against me. Because in this environment, the expected value of losses is much higher. So, at least cash only has inflation. And it's not that I'm going to hold cash long term. It's that, I'm remaining in, holding more cash to seize those opportunities when they occur. And when you look at the chart and you see something coming into a good entry for you, when it's establishing a nice trend like Seagate did, and, AMD and gold recently, it's nice to have that cash available to seize those opportunities. So very smart. And reduce position sizing is key. It helps reduce emotions, the reactions from the emotions attached to that trade, and it also minimizes risk. So I think it's ideal for us to go right into mindset and trading psychology, because we touched upon it the whole time. Your mindset is just fantastic. We want to go into your mind. I love how you keep talking about simplifying, and that's key. Like you just said,
you have to.
Too many positions on, and I love that, because we have bandwidth constraint. So you just said, why have all these positions? It's just too much noise.
It's too much.
Yeah, tell us about your mindset and how you minimize the impulsiveness and stay calm, because calmness is what blue chip Larry's all about.
It's what it comes down to for me is knowing my limitations. And the last quarter of last year, I did too much. The last quarter of last year, I hit 1 or 2 good short positions, but I overplayed that hand. And I got into, because there was some, crude oil was unwinding, tech was unwinding, and I did too much. And then I missed some good entries because I was a little bit outside of really where my wheelhouse is, because I saw these downtrends. So the first thing I think that's most important is I think that everyone needs to try to focus on limited information. And what I mean by that is, me personally, I have a difficult time trying to trade long and short at the same time. I have a difficult time trying to day trade and swing trade and trend trade at the same time. And to be honest with you, realistically, people can be great at just focusing on one thing. So there's, to the best of my knowledge, there's nobody that's in the baseball Hall of Fame, the football Hall of Fame, and the basketball Hall of Fame, all 3 at the same time. You can't be great at multiple. If you want to be great at football, then you focus on football. If you want to be great at baseball, you focus on baseball. But I think what makes people great at what they do, or what makes people excel, is just a focus on, one thing. So for me, where I do best is to focus on uptrends, and then either pullbacks or breakouts in those uptrends. That's the best for me. Anytime I deviate and I start to go to the short side or options or things like that, what it does is it takes my focus off what I do best. So, and it's the same thing with my charts. If you look at my charts are very simple. But to me, I can look at, you could give me any symbol in the world and I can plug it into that chart. And in 5 seconds, I know if I want to have a position or if I don't want to have a position. Because I've looked at over 25 years, I don't even know how many charts, thousands, tens of thousands, maybe hundreds of thousands of charts. So I know this is what works for me, and this is what doesn't work for me. So I think what most people need to do from a mindset perspective, don't try to be everyone. There's some great traders that we know of that are shorter term traders, swing traders. They look for 3 to 5% moves and then they're out, and that works great for them. But you have to figure out, does that work great for you? And for a lot of people it does, and for a lot of people like me it doesn't. I can't function with taking 3 to 5% gains and then going to find another stock and looking for a 3 to 5% gain. Some people are really good at it, but it's not what I'm the best at. So what I would say most people should do from a mindset perspective, figure out who you are. Do you want to be a day trader? Do you want to be an options trader? Do you want to be a longer term trend follower, position trader? You know, what works best for you? And then just try to focus on that. But you have to find who you are in the markets. There's some people that cannot disconnect from fundamentals. There are some people that can't look at a chart and just say, okay, that's a downtrend or that's an uptrend. They want to overthink it. And I think that I just think that the more cooks you have in the kitchen, the more convoluted your cake can get. So we just have to figure out who we are and then practice that every day.
Excellent, wise words. Avoid overthinking. Agree completely. And like you said earlier, there's many ways to skin a cat. I love your little anecdotes that you say. They're so funny. But there's so much value and wisdom in that. Knowing yourself, have your own way, and know what works for you and what doesn't. And don't follow people blindly. You know, a lot of people on social media, Twitter, yeah, right? They follow and they see these gains. They're like, oh, all they do is win, and they try to replicate that, and it's not for them. You know, and it's very important to know what works for you. And you know, focusing on one chart at a time. And I think you made a tweet about this.
Oh yeah.
Yeah, if you want to look at QQQ, there's no reason to be looking at IWM and other charts. You should focus on that one chart. Less is more.
Right.
So it's very important. There's no reason to do cross-market analysis. You know, simplify. You know, and you know, you had a great quote that you tweeted about, and to me, it's you. It's exactly how you trade. And you said, you quoted, I think, Paul Tudor Jones, and you said, every day I assume every position I have is wrong.
Yeah.
And that's about being humble. And that keeps you humble, because overconfidence is the mother of all biases.
Yes.
So tell us about that quote and how you apply that, how it relates to you, and how you stay humble and calm, because your calmness is key. And how do you avoid fear of missing out? And that's a big one that gets a lot of people. They feel rushed and they feel this impulsiveness to buy. How do you avoid that?
It's a couple things. What started for me is I struggled for years at first. So I started in 98. Everything went up for like 15 months. It didn't matter what I bought. And I had, Cisco, Home Depot, all those stocks. But then I got blown out between 2000 to 2002. I got blown out. I lost a lot of money. I held stocks like, Nortel Networks and JDS Uniphase. These were stocks that you couldn't go wrong in. And I lost a lot of money. So I basically blew out my trading account and I just stopped trading. I said, okay, that was really bad and I'm done. But I had a passion. So I came back to the drawing board. You get beat up and you're like, okay, that wasn't good. But I came back to the drawing board and I said, there has to be a way where I can avoid having this happen to me again, where I can avoid buying Cisco systems and it goes all the way down. And I eventually came across technical analysis. I had studied it before. And all I wanted was just something that was on the chart. It wasn't my opinion or me having to read, Financial Times every day. I just wanted something on the chart that if something happened, it would tell me, okay, you needed to sell this stock. And I came across the 200-day moving average somehow. And I went back all the charts for Cisco and EMC and Nortel Networks and Sun Microsystems. And I said, if I just would have sold those stocks when they closed underneath their 200-day moving average, I would still have my money. So, and then I discovered Michael Covell. He's written a lot of books about trend following, very, very good books. And I discovered Jesse Livermore's book. And that's when I said, okay, Jesse Livermore, basically, he described me. There was a page in the book, he says that there are men that can buy stocks at the very beginning of a bull market and not make any money because they overtrade it and they're doing all this and going short and all that stuff. And I said, hey, that, I did that before. So I had to figure out what, technically on these charts, a system. So I spent a lot of time. I talked to Tom Basso, who a lot of people on Twitter know Tom Basso. He's been in the Market Wizards book. And I just told myself, I'm not very good at looking at the news or looking at a balance sheet and trying to figure out what a stock can do because there's no consistency there. So I just had to develop a technical system for myself, and I did, and that's what I follow. But I just assume every single position I go into, I set a stop loss because I know that I can be wrong. And you can be wrong 50% of the time. You can be wrong more than 50% of the time and make money over time. You could be right 90% of the time and go broke. If you're right 90% of the time and you take 2% gains, 3% gains, 2% gains, and then you load up on the big trade and you can get wiped out. So it's not about being right. It's about knowing that you can be wrong a lot and setting up your positions. When I bought gold and I have a stop. If it hits my stop, I'm just out of it. I could have 3 stops get hit in a row, 4 stops get hit in a row, 5 stops get hit in a row. But I know that over time that my system is going to make a lot of money. I know that I might get stopped out for a negative 10% trade, but I also know that I'm going to have some plus 20s, plus 30s, plus 40s, and plus 50s. So it comes from, I lost a lot of money. I came back and I said, what can I do different? And over time, I've worked out a system for myself that I'm very comfortable with. And it's like anything, who won the Super Bowl? The Kansas City Chiefs, right? They didn't win every game this year. Patrick Mahomes doesn't only throw touchdowns. He throws interceptions. He gets sacked. He fumbles the ball. But guess what? Over time, he's one of the best. Over time, Tom Brady's one of the best. So the thing is, to get a system that works for you, but don't change it all the time. don't change because, okay, I got stopped out a couple times. Let me try this and try that. So and that's why I stay calm, because I go into stocks and you're a subscriber of mine. I'll take a position in C, and in the email, I'll say, listen, this is a high volatility stock. There's a good chance it might not work out. So guess what? When it's down 5% one day, I don't, panic and hit the sell button, because these are the positions that I'm in. So I think that you have to accept, if Paul Tudor Jones walks in every day and says, everything could get stopped out today, that's the same mentality that I have. I just assume that all my positions could get stopped out anytime for any reason.
Excellent points. And it's important to remain objective and reduce the subjectivity. And I love how you use technicals to give you that information. Price is the ultimate determinant, and that's telling you what the trend is. And I appreciate you sharing your losses with us. I mean, we learn from our losses, and that's what helps build that experience and knowing ourselves. And we want to shorten that feedback loop in order to enhance our performance. And you build a fantastic system. Love your truth and transparency and how you share everything. And you mentioned about remaining calm, and it's also about not panicking and selling out of positions. So not only not rushing into them, but also not rushing to sell out of them. And intuition is calm, and there isn't that impulsiveness. Emotions are good. Emotions tell us about ourselves, but it's about avoiding those impulsive reactions that come from heightened emotional states. And you certainly are calm and the voice of reason on Twitter. That's what I think of you as, Blue Chip Larry. Can you please tell us how people can learn from you and follow you, and tell us about the services you offer, please?
Sure, I appreciate that. So the first place to find me on Twitter is at LMT978. I've been on Twitter for a little bit over 10 years now, so it's been a lot of fun. I've made a lot of good contacts like you through Twitter.
Thank you.
And then on my website, bluechipdaily.com is my website. And there's a couple different pages, but the key thing is I like to share my technical process so that people can see, okay, here's a chart for gold miners. And that was our chart of the day about 3 weeks ago. So what I do for members every day is I post a chart of the day where I post a chart that I believe for the most part is actionable right where it sits. So I dial up my charts and I say, this chart to me looks like it's ready to move higher, and here's why. So if people go to my website, what they can do is scroll through about 3.5 years worth of technical posts that I've put up to understand, what is the mindset, what is the technical system. Here's one that we posted. I posted this March 27th. It was very simple. The S&P 500 had a bullish 8-day, 20-day moving average cross. And from that signal, the S&P actually went about 100 points in 4 days. So if people want to learn more about, my mindset, my technical methodology, they can go through, just pages and pages of charts, explanations. I've got videos on the website where, I've talked about past trades, both winners and losers. So there's a lot of educational content on the site. Obviously, it's also a subscription-based service. So I give technical ideas through the day. I share my buys and sells, but there's a lot of educational content. We've got videos that go back a couple years, and there's just really a lot of information for those that are learning, how to trade, what to look for on the upside, downside. But yeah, Blue Chip Daily, that is my website.
fantastic website, and you do stay ahead of the curve there, and the trend. I mean, with that gold chart a few weeks back, it's had a great trend since, and great call outs that you've made. And I know on your website you mentioned, I think it's also on Twitter, how all these fantastic calls you've made over the years. So really respect you. And thank you so much for taking the time to speak with us all today and enlighten us with your trading strategies, trend analysis, and market psychology. Thank you so much. And I will be linking your YouTube channel as well, which I know you're going to be growing, because you are a fantastic teacher. And we look forward to meeting up again. Thank you.
Rosanna, thank you so much for having me on. As I said, I'm proud to say that I knew you before you had a podcast, before you had all these followers on YouTube, and I got in on the ground floor of the Rosanna social media blitz. But thank you so much for having me on. I really appreciate it. I'm glad to share whatever I can with you and your subscribers. And I wish you 10,000% success with your website and your podcast.
Thank you so much. You're so sweet. I wish the same for you. So thank you so much. You're a dear friend.
Thank you.